So now let's discuss what I had shared with you, the one for dividend policy. So, and dividends are part of the earnings which are paid to the shareholders for the investment they have made in the company. And what are some of the factors we consider when making the dividend policy? Yeah, when the company maybe decide whether to pay 40%, 50%, or 60% of the earnings of the dividends. So what are some of the factors that determine this choice? Number one is the availability of investment opportunity. Yeah, if a company has more investment opportunity, they expected to pay lower dividend so that they can retain more to be utilized in undertaking those projects. They're saying that. Now, companies with several investment opportunities yielding positive NPV are likely to pay less dividend. Good. Another factor is the profitability and the liquidity of the company. They are more profitable company, you expect them to pay more dividend and vice versa. Then we have the industrial norm. The company might tend to adopt the dividend policy equivalent to the other companies in the same industry. Then number 4 is the capital structure decision. We're saying that where the company wants to achieve a given capital structure, e.g. where the gearing is too high, the gearing is the use of the debt. Where the gearing is too high, the company may pay less dividend and they retain more. Number 5 is the restriction by the debt holders. Yeah, that one arises as a result of what we call the agency cost. That is what we call the agency cost. Now, agency cost arises as a result of restriction put in place by the debt holder. So you're saying that there are terms and conditions of our own agreement which may restrict the company from paying dividend unless the earnings of the company exceeds a given limit. Another factor that might determine is the expectation of the shareholder. Yeah, one of the way of minimizing the conflict between the company or the management and the shareholders, first of all, is the expectation. And in that case, one of the way to minimize the conflict is by paying them higher dividends. So you're saying that shareholders with high income will prefer capital gains. We'll come to discuss that later. There is a theory that tries to explain that. Why the rich people and wealthy people, they prefer a company that pays less dividend or no dividend at all. But in that case, they promise them high dividend. Number 7, another factor is the access to the capital market. Now, a well-established company which has a wider access to the capital market, they can pay higher dividend so that even if they pay 100% as dividend, they can be able to access the capital market to get the new funds and vice versa to a small company. Another one is the inflation. Then number 9 is the nature and the tax position of the company. Yeah, they have the tax rate, the lower the profit, the lower the dividend. And then also there is legal requirement that regulates the payment of dividends. Good. So now let's look at dividend policies. Dividend policies. What are various dividend policies that a company can adopt? Number 1, we have what we call the constant. And what do we mean by the constant dividend payout ratio? Now, under this policy, the company will pay a fixed proportion. Can you underline proportion? Underline fixed proportion. We are not talking about the fixed amount. It's all about the fixed proportion. Yeah, the company will pay a fixed proportion of its earnings available to the ordinary shareholders as dividend. Yeah, for example, the company might have a dividend payout ratio maybe of 30%. So regardless of the profit they make, now they should distribute 30% of their earnings to the shareholder. So that's one of the policies, the constant dividend payout ratio. Then number 2, we have the constant or the fixed dividend. And this is where now we treat the ordinary shareholders like preference shareholders, whereby you promise them a fixed dividend per share for each period, regardless of the amount of profit paid. For example, you can them to be paying 5 shillings per share every year. So regardless of the profit the company makes, so the dividend will remain to be constant. What does that mean? That means that the dividend for period 1 will be equal to the dividend of period 2, period 3, up to period 10. So that's the fix of the dividend, fixed dividend per share. Another one is regular plus extra. Regular plus or bonus. Now, this happens whereby the company will set our dividend per share, which is guaranteed, and also they are promised an extra dividend in case the company undertakes all the investment project. Now, what will it mean? Now they be paid now as a bonus. So, whereby the company will set a raw dividend per share, raw dividend, but a guaranteed one, and then they are promised an extra or bonus dividend when the company makes abnormal profits or when the company undertake all the projects, and then the balance they'll be paid as a bonus. So you're saying that this is where the dividend per share is set at a very low level, but paid each year. So it's guaranteed. However, extra or bonus dividend will be paid during the period of high earnings. And lastly, we have the residual dividend policy. Residual dividend policy. And this one is applied by a given class of companies whereby the majority of the shareholders are wealthy people, whereby the company, they should only pay dividend. You have nothing to do, they don't have any investment to undertake. So the company will only pay the dividend only if there is no investment opportunity they can take. So that means in this case, for example, this company have various projects A, B, and C, of which all of them are viable. So what will happen once the company makes the profit? They give priority to all the viable opportunities, investment opportunity. Now, in case there is balance, that's the only time they pay the dividend. That's the only time they pay dividend, but it's not guaranteed because in most cases, the company should assess the feasibility of various projects, determine which one are profitable, which one are not profitable. So in this case, we only pay the dividend if the company has no other viable project to undertake. So we'll come to discuss about another theorem which tries to explain this class of investors. Good. So we're saying that this is where the dividend are paid out of the earnings left and all the viable investment opportunity have been financed. Therefore, in this case, the company will pay dividend only if there is no profitable projects to invest in. Good. So I want us to do that illustration. Do that illustration. So illustration 1. You are told that the management of JM Limited is in the process of evaluating the company's dividend policy. The following information is provided. So we have number 1. The company paid 1.2 million shillings as dividend in the last financial year. So those were the total dividend paid in the last financial year. Number 2, the profit after tax for the last financial year was 3.6 million. The company has not issued any preference share. The earning growth rate has been constant at 10% per annum for the past 10 years. The expected profit after tax for the current financial year is 4.8. So that's the expected profit. Number 6. The company anticipates investment opportunity of 1.4 million in the current financial year. And then number 7, the capital structure of the company consists of 60% equity, 40% debt required. Now, before we go to the required, can you read that question again? Read that question again. So required. Now determine the optimal total dividend for the current financial year if the company wishes to adopt the following independent dividend policy. Number A is a pure residual policy. So number A, if they adopt pure residual dividend policy. Yeah, we have said that for the pure residual dividend policy, this is where the company will only pay the dividend after undertaking all the viable investment opportunities. So we have the expected profit. Yeah, because we pay the dividend from the profits for the year. And how much is our expected profit? So the expected profit we have is 4.8 million. And then you undertake any capital expenditure or the capital investment. For the capital investment, you told that the company anticipates investment opportunity of 1.4 in the current financial year. So the only investment available is 1.4 million, but we are given the optimal capital structure, number 7. The capital structure of the company consists of 60% equity and 40% debt. Now that's what we call the optimal capital structure. That means if you are to undertake any capital, any capital investment, 60% will come from the equity, 40% will come from the debt. Now we have an investment of 1.4, of which expected profit, that one affects the profits. That's part of the equity, it's part of the retained earnings. So therefore it's the equity. So that means of this 1.4, the amount that will come from the equity is 60%. So how much is that? $0.84 million. Now, the balance is now what will be the maximum dividend to pay. Maximum dividend payable. So they'll pay a dividend of 3.96 million. Good. Number B of the question, number B. Constant dividend payout ratio. We adopt constant dividend payout ratio. Yeah, so how do we get the dividend payout ratio? So to get the dividend payout ratio, you take the dividend per share over the earnings per share, which is the same as the total dividends you divide by the total earnings. And how do you determine the company's dividend payout ratio? So you tell that number one, the company paid 1.2 million as dividend in the last financial year. So the total dividend paid in the last financial year was 1.2 million. Then you compare against the profitability for the same period. Number two, I tell that the profit after tax for the last financial year was 3.6. So 3.6 million. And therefore, the dividend payout ratio is a third, which is the same as 33.33%. Good. So therefore, now let's determine the maximum dividend payable. So if the dividend payout ratio, they pay a third of their earnings as dividend, the same will happen to this financial year. You take a third of the expected profit after tax, which is 4.8 million. 1.6 million. Then number C. Stable predictive dividend policy applying the growth rate equivalent to the earning growth rate. Stable predictive. Now, predictive is when you expect it to grow. And in that case, to get D1, it's DO1 plus G. As simple as that. That's how we get the predictive of the expected. And we are told that, first of all, DO is the most recent dividend per share. But in this case, what we are given was the total dividends. So the total dividend paid during the last financial year, we are given in note number 1, that the company paid 1.2 million shillings as dividend in the last financial year. So DO is 1.2, then 1 plus the growth rate. Number 4, the earning growth rate has been constant at 10% per annum for the last 10 years. So the growth rate is 10%. And now let's go back to the required number C. Required number C. We have to use the stable predictive dividend policy, applying growth rate equivalent to the earning growth rate. So we assume the same growth rate of 10%. So therefore, how much is our expected dividends? $1.32. That's the number D. Regular plus extra dividend policy. So we have to use the regular plus extra. Now, how do we get regular plus extra? So we have the expected profit. Now, the expected profit is 4.8 million. And then we pay the regular dividend. Regular dividend, of which we are told that. Let's go read number D again. Regular plus extra dividend policy. How to determine the regular? The regular dividend will be based on long-term growth rate. Yeah, will be based on the long-term growth rate. So this is our regular. Will be based on the predicted expected growth rate, which is 1.32. 1.32 million. So how much is the balance? So that's the regular. $3.48 million. Then to get the extra, you undertake any viable capital investment. Now, what will remain after now taking the that capital expenditure is what you pay now as an extra dividend. So you raise the capital investment. Read number D again. We're told that regular plus extra dividend policy, and the regular dividend will be based on the long-term growth rate earnings, while the extra dividend will be based on the residual income. Residual is what will remain after undertaking all the viable projects. So you have paid the regular dividend, then you will take the capital expenditure. Now, the expected project, it will cost 1.4, but we have the optimal capital ratio. I mean, optimal capital structure, whereby 60% is equity, 40% is debt. Now, profit is part of the equity. So therefore, the amount that will come from equity, the equity ratio is 60%, of which we got was an amount of 0.84 million. Once we take the capital project, now the balance becomes our extra or bonus dividend, which will be an amount of, sorry, 2.64 million. So therefore, total dividend payable. So number 1, they received the regular dividend. Yeah, the regular dividend was 1.32 million. And then they have received extra or the bonus dividend. And the bonus dividend is 2.64 million. And in that case, you get an amount of, you get 3.96. As simple as that. So you already have that in your notes. So I want us to try another. September 2021, question 2. Maridadi Limited is a firm that operates in textile industry. The firm operating profit, that is earning before interest and tax over the next 5 years, are forecasted as follows. So we have from year 2021 to 2025, we have the operating profit. The firm expects to incur a fixed financing cost of 20 million in 2021. So there is something I wanted to change. Yeah, so that the firm expects to incur a fixed financing cost of 20 million. That should be 2 million, not 20 million. And this is expected to rise at a constant rate of 10% each year. The firm acceptable investment to be financed each year are given as follows. So we have the amount. Number 3, the corporate tax rate is 30%. The number of issued ordinary share are 10 million. And these are expected to remain constant each year. Required. The dividend per share payable in each year, assuming the firm adopts 40% payout ratio as dividend policy. So here we have a constant dividend payout ratio. Yeah. Payout ratio. So you take our operating profit, that's the earning before interest and tax. So here we have is 10. We have 12. We have 15. 16. And we have 18. So that's the earning before interest and tax. We raise the interest. We are told that in note number 1, the firm expects to incur a fixed financing cost. Yeah, financing cost is the interest of 2 million in year 2021. So this will be 2 million, not 20 million. This is expected to rise at a constant rate of 10% each year. So it's expected to increase. So this one will be 2200. So give me the earning before tax. Then we deduct the tax. So you raise the tax at the rate of 30%. Okay. So now give me the profit after tax. Zero. Then? $83. So now, once we get the profit after tax, now our concern is the dividends. So we determine the dividends or the total dividends. So you're told that number one, required number one. The dividend per share payable in each year, assuming the firm adopts 40% payout ratio. So 40% of the profits. Sorry? But what we need is the dividend per share. So to get the dividend per share, take the total dividends, you divide by the number of ordinary shares. So we are told that, where's that? Yeah, number 4, we have 10 million ordinary share. So divide by 10,000. 2240 divided by 10,000, you get? Number 2 of the question. Number 2. A dividend payout ratio, dividend per share payable in each year, assuming the firm adopts a residual dividend policy. So if you adopt residual, dividend policy. So we have the profit after tax. And then once you have the profit after tax, first of all, you gotta take the capital expenditure. So you invest the capital expenditure or the capital investment, of which you already given the acceptable projects. 2021, it's 3 million. And now that's how we get now the total dividends. So the dividends payable. We get an amount of 26. I'll get an amount of 2360. Get an amount of that 806. And he'll get an amount of 20. So now we can be able to get the dividend per share. So you divide by the number of shares, of which we have 10 million shares. So here we'll have 0.26 and 236, 306, 337, 0.355. As simple as that. So you can copy that. That is not in your notes. So now let's look at other models of dividend policy. So one we have is James Walter model of dividends. Yeah, actually the James Walter is a model of valuation whereby it also the prediction of dividend, it's all about the prediction of dividend and how it affects the value of the share. So therefore it's a valuation technique. So this is a model of share valuation which supports the view that the dividend of the company affect the value of the share. The dividend policy of the company will affect the value of the share. And according to James Walter, what were the assumptions? One is that the company is all equity financed. Yeah, that means there is no debt in the capital structure. Number two is that the company uses retained earnings to finance future investments. Also is that return on investment will remain constant and the company will exist to perpetuity. Yeah, that means it remains to be a going concern. And based on this assumption, Walter came up with a model of valuing ordinary share as follows. So according to James Walter, to get the intrinsic value of the share, that is the PO, is equivalent to plus the retained earnings per share. And how do you get the retained earnings per share? You take the earnings per share minus the dividend per share, R over K over K, where what is D, what is E, what is R, what is K? D is the dividend per share, E is the earnings per share, R is the required rate of return. Yeah, rate of return for the investment. And K is the cost of capital. Cost of capital. Good. So now let's do an illustration. That illustration one. You are provided with the following information from the books of JM Limited. So you have the rate of return on investment is 20. So that is R. R is 20%. The cost of capital is 15%. And that is K. K we have is 15%. Earnings per share is 4 shillings. And the dividend per share is 2.5. Now required, using James Walter model, determine the value of the share. Using the James Walter, determine the value of the share. So to get the value of the share, that is PO, take the dividend per share, you add the retention ratio per share. That is the earnings per share minus the dividend per share. And then R over K. Okay, so you have the dividend per share is 2.5. Then the earnings per share we have is 4. Then the dividend per share is 2.5. So that means the retention ratio or the retained earnings per share will be 1.5. Then R over K, so it's 0.2 divided by 0.15 over 0.15. So, get an amount of that. Open May 2017, question 2. And the following information was extracted from the financial statement of Mwaka Limited. So we have the earnings per share. So and that's our A is 15 shillings. Capitalization rate, that is the cost of capital, which is 12. We have the retention ratio is 40%. And then we have the internal rate of return, that is R, which is 16%. Required. The price per share under one is a golden growth model, and then number 2 is Walter. We start with golden. And then number 2, James Walter. Yeah, we have already done using the golden model. So first of all, let's start with James Walter. James Walter, to get the intrinsic value of the share, PO is D plus the earnings per share, the dividend per share R over K, and then over K, whereby we have the dividend per share. So we don't have the dividend per share, but to get the dividend per share is very simple. We have the earnings per share, which is 15, and then you are given the retention ratio. Retention ratio is 40%. That means we pay 60%. And you get an amount of 9. So therefore, the dividend per share will be 9. Earnings per share, which is 15, minus the dividend per share of 9, so that you get the retained earnings per share. R over K. So R is 16. K is the cost of capital, the capitalization rate. And then you divide by K, 0.1. Okay. $1.67 shares. And then golden model, growth model. This is what we have been doing. Yeah, from the date we started the cost of capital. How do you determine the cost of equity or the cost of ordinary shares? See, that is DO 1 plus G, and then PO plus G. Now, this is what we call the golden model. So therefore, how do we get PO? PO is the market price per share. So to get under golden model, PO, and this is what we are doing using what we call the constant dividend growth rate. We did the variation of shares as the other day. And under constant growth rate, so that to get PO is DO 1 plus G R minus G. That's what we call the golden model. Whereby we have DO, so it's 9. 1 plus the growth rate, we are not given the growth rate, but I gave you 2 methods of determining the growth rate. There is the compounding method. Compounding is where you are given a series of past dividends. In this case, we are not given. And the other one was the retention ratio method, RBE, whereby you see that R is the retention ratio, and then BE is the return on equity, or the required rate of return. So therefore, to get the growth rate, we have the retention ratio. So the retention ratio is 40%, and then return on equity. So the return on equity, so in that case, we have the internal rate of return, 16%. So how much is the growth rate? Yep, 6.4%. Good. So it's DO 1 plus G, which is 0.064. R. Now, R in this case, we said what is R? What is R? Now, don't confuse James Walter. R is the rate of return. K is the cost of capital. But in this case, okay, our KE, what you're computing here, is what is our R there. So this is the cost of capital. Good. So in this case, note that under James Walter, R is the required rate of return, but R in this case is the cost of capital. Yeah, that's the cost of the ordinary share, and of which we have the cost of capital, that's the capitalization rate. We have is 12, so it's 0.12, and the growth rate is 0.064. Give me that. Good. Good. So in your notes, James Walter is there. Gordon is not there. So you can copy that for Gordon in your notes. So the second method or other model of dividend policy is John Lintner's. Yeah, John Lintner's model. So now, according to this model, the dividend to be paid, yeah, that's the dividend to be paid. So it's a prediction model. The dividend to be paid takes into account the current dividend, that's the dividend paid for the past the current financial year, the adjustment rate, and the previous dividend. Therefore, according to this model, the dividend per share to be paid will be expressed as follows. So you're saying that under John Lintner, the model predicted dividend to be paid by taking into account the current dividend, the past dividend, and the adjustment rate. And according to John Lintner, how do we get the dividend per share to be paid? Yeah, to get the dividend per share to be paid, we take the current dividend per share times the adjustment rate. And then you add the previous dividend per share times 1 minus adjustment rate. like that. So it's a combination of the current and the past dividend taking into consideration the adjustment rate. So open December 2013, question 4A. December 2013, question 4. Now, the following data was obtained from the financial statement of Nemax Limited for the year ended 30th of September 2013. So we have the earnings per share for 2013. Now that's the dividend for the current financial year, which was 3 shillings. The dividend per share for 2012. Now the dividend for the last financial year. Target payout ratio is 0.6. And then the adjustment rate is 70% required. Using John Lintner model, determine the dividend per share of Nemax Limited for the year ended 30th of September 2013. Determine the dividend to be paid. So to get the dividend per share to be paid, so you take the current dividend per share. And how do we get the current dividend per share? Now, the current financial year is 2013, of which we are given the earnings per share for 2013, which is 3 shillings. But what we need is not the earnings. So what we need is the dividend. So you convert the earnings into dividend, and you're given the payout ratio. Payout ratio is 60. So that means we pay 60 as dividend. So if the earning was 3, with a payout ratio of 0.6, you're able to determine the dividend. Once you get the dividend, you multiply by the adjustment rate, which is 0.7. Then you add previous period dividend per share, that is 2012, and the previous dividend for 2012 was 1.2. 1 minus the adjustment rate. Adjustment rate was 70%, therefore 1 minus 0.7, you get 0.3. So how much is that? $1.62. Open May 2016, question 2B. The following information related to dividend per share for Zomoro Limited. So you have the earnings per share for year 2016. That's for the current year. Dividend per share for 2015. That's the dividend for the previous period. Target payout ratio is 60% or 0.6. Adjustment rate is 0.7. Using the Lintner's model, predict the dividend per share for the year ending 31st of December 2016. So to determine the dividend per share to be paid, so take the current dividend per share, of which we have the earnings per share for the current year, that is 2016, which is 6. But you convert the earnings into dividend per share. So we have the target payout ratio, so we pay 60%, so you multiply by 0.6, so that now you get the current dividend per share. Then you multiply by the adjustment rate, which is 0.7. And then you add the previous period dividend per share, of which you have the dividend per share for year 2015, which was 2.4, 1 minus the adjustment rate, which is 0.3. 3.24. Yeah, so that is James Walter and John Lintner's model. Good. So now let's look at some terminologies there. We have some terminologies. One, we have what we call the homemade dividend. Now, homemade dividend, this is where, yeah, demonstrate is applicable, where the shareholder want a liquidity. Now, in this case, the company is not willing to pay dividend, but the shareholder needs some cash. So what they usually do, they just pay themselves the dividends by selling some of the shares. Yeah, you liquidate some shares so that you get some cash. So saying that it refers to the ability of the shareholder to liquidate or sell part of the shares and realize cash flows, which will substitute the dividend income. Under this policy, the dividend is irrelevant in determining the value of the company. Number two, we have the best effort offering. And this is a system used by investment bank whereby they agree to sell as many security as they can at an established price. So can you attain established price? Yeah, so that means they determine the price in advance. Yeah. Then number three, we have what we call the preemptive rights. And under this model, the existing shareholders have the right to preserve their proportionate ownership in the company. Yeah, mostly this word is used in rights issue. And then number four, we have what we call the green shoe provision. Under this provision, the shareholder has an option to buying additional shares of at the initial offer price after several weeks from the time of the rights issue. Yeah, mostly this one happens when there is a private placement whereby the company have effected a rights issue, and maybe the right issue is to take place maybe in 3 months. But there is one shareholder, a serious one, who maybe expect to invest to buy shares maybe worth 20 million, but expect to receive the 20 million after 4 months, not within 3 months. So in that case, the shares will be preserved. Even after 3 months, he'll be able to buy those shares at the offer price that was currently issued by the company. Good. So now let's look at theories of dividend policy. The dividend policy theories. Now, this theory attempts to explain whether the payment or non-payment of dividends affect the value of the company. And they include, one is the agency theory. Yeah, I'll share with you a document for the introduction whereby you read about the conflicts that exist in an organization between various stakeholders, management, shareholders, management, auditors, management, government, shareholders, government. What are some of the causes of the conflict and how to resolve them? I'll share with you that. There is a conflict that exists between the management and the shareholders. So one of the ways to resolve the conflict between the two, because management mostly, shareholders, they elect the board members. So that means BOD or the board members, they are part of the management, of which they'll be elected by the shareholders. So assuming there is a conflict between now the management and the shareholders, now the management can use the dividend policy as one way of the solution to solve their conflict. That means you just read the mind of the shareholders. If the shareholder, they expected maybe a dividend of 3 shillings per share, you pay them double. What will happen if someone expected a salary of 30, and then you decide them to give them 60,000? Even if that person hates you, he started thinking that he is the problem, not the management, right? Yeah, so that's one way of solving the agency problem that exists between the shareholders and the shareholders and the management. So saying that the agency problem between shareholders and management can be solved through the payment of high dividends. Then number two, we have what we call the bird in hand theory. Now, bird in hand theory mostly is affect the risk averse shareholders, whereby you are buying shares somewhere, but in this case, you want a guaranteed dividend. You know, sometimes a company can make profit and decide not to pay dividends. But in this case, you want an assured dividend. Better they pay you just a small return, but a guaranteed one. That's what we call bird in hand. So better ile kidogo or guaranteed rather than being promised capital gain after 5 years. Yeah, so that happens in the bird in hand theory. The thing that this theory was developed by Mayon Gordon and John Lintner, and is based on certainty of the income derived from the shares in form of dividend and capital gain. And the theory is summarized as follows: that investors are risk averse. They fear risk, and therefore they prefer assured income. Good. So now let's go to number three. Number three is the signaling theory. Yeah, signaling theory, this is where if the company proposes a higher dividend, so that signals that they expect higher profit, and vice versa. That's what we call the signaling theory. And that signaling theory, actually, it also affects the market price per share. Yeah, because when the company expects the profit to go up, that one have a direct influence, he said, to the shares. Yeah, we discussed that at what we are saying, that efficient market. See that an efficient market hypothesis, once the information is given to the market, it will be directly affect the share price of the company. So you're saying that, and the signaling theory, that this theory suggests that the payment of high dividend will signal that the management expect high profit in the future. So to maintain their higher dividend payment, this will lead to increase in the value of the company. Yeah, because if the share of the company goes up, the value of the company also increases. And then we have clientele theory. Yeah, now clientele theory. Now this one is for risk takers, serious investors, and wealthy investors. And who are these wealthy investors? Now, clientele theory, it says that most of the shareholders, they prefer a company that pays no dividend. You like a company that does not pay dividend? No. But this is a group of wealthy shareholders or investors who prefer a company that does not pay dividend, or they pay very little dividend, but they promise them higher capital gain. Now, for example, let me ask you a question. Here we have a company, and this company, they made a profit of, let's assume, 10 billion. And then assume that they have a payout ratio of 50%. So that means 5 billion is to be paid as dividend. Now, why do this wealthy investor don't want this dividend? Now, number one, a wealthy person or a serious investor is someone with different stream of income, right? The more income you earn, the more you'll be taxed. So that means if you get more dividend from the company, and you see, if you're well, that means that you have various sources of income. You have various sources of income. So this 5 billion also will increase more of your income, of which the more income you earn, the more dividend you pay. So in this case, they ask a company, now, if you give us this 5 billion, don't you have any investment that you can undertake with this 5 billion? Are you getting? Instead of giving that money, you give me money. I already have money. Are you together? Why don't you use that amount to go and buy another company? You do what we call a consolidation. Or you go, you take another project, and then that project grows. In that, this 5 billion, in 5 years, I want this company now to be worth 30 billion. Are you getting the rich man, the rich person mindset? Eh? Instead of giving the short-term income, go and invest that money. Because even if you pay me now, I already have other sources of income. Eh? And if you pay me more, the government will come for that for tax. So it increase my tax burden. So I can hide behind the company, don't pay me the dividend, go and invest that money. So that in the future, I increase my wealth status. So you're saying that this theory was developed by Richard Petit, who argued that different group of shareholders have different preference of dividends, depending on their level of income from other sources. The theory is summarized as follows. One, that if a group of shareholders has high income from other sources, prefer low or no dividend in order to avoid the additional tax burden. They'll therefore shift to the company which is paying low or no dividend, but promising higher capital gains in the future, and vice versa for shareholders with low income. Good. So that's the clientele theory. Lastly, we have another pair there. Those are Modiglian and Miller. They contributed a lot in world of finance. But now the problem is that for every theory they contributed, or the theory, it was to criticize. So they just wait for other professors to come up with a theory, and then they look at that theory, they tell you that that theory does not make any sense. So it's all about to criticize. So they prove that every theory you come with it, they prove that that model is irrelevant. But yeah, they are known as Modiglian and Miller. So this theory was developed by Modiglian and Miller, so known as dividend irrelevance theory. Now, this theory was developed by Modiglian and Miller, argued that the company dividend policy does not affect the value of the company. Yeah, the dividend policy would not affect the value of the company. But all the other theories, they say that the dividend policy of the company affects the value of the company. But according to does not. The theory operates under the following assumption. What are the assumptions? One, that there is no transaction cost associated with flotation of shares. Also, that there is no corporate and personal taxes on dividends. That the company investment policy is independent of its dividend policy. And also there is no uncertainty in the market. Hence, all investors use the same discounting rate, and the capital market are efficient and perfect. Now, based on this assumption, what happened? The dividend irrelevance model can be provided as follows. So, according to how do we get the P1? P1 is the expected dividend, or PO. Here is the value of the share. To get the market price per share is equals to P1 plus D1, 1 plus R. And how do we get the new amount is MP1? To get MP1, you take the expected income plus dividend plus ND1. And how do we get the new shares to be issued? You take MP1 over P1, and therefore, how do you determine the value of the company? So to get NPO, we take N plus M P1 plus the investment amount minus the expected profit, and then 1 plus R, where what is PO, what is P1, what is D1, what is MP1, what is M, what is NPO, what is N, what is M, what is I, what is X. PO is the current market price per share. P1 is the expected market price per share. D1 is the expected dividend per share. MP1 is the new funds to be raised. M is the new shares to be issued. NPO is the value of the company. N is the current number of ordinary shares. M is the number of new shares. Oh, that one I have already explained. X is the investment amount. and X is expected profit. Yeah, expected. So I want us to do an illustration on the same. May 2014, position 3. We start with part A of the question. Explain the term agency theory as applied in financial management. Yeah, agency theory. So I'll share with you the notes that explain that. Then number B, discuss 3 factors that a company should consider when formulating the dividend policy. We also discussed that. Probably had given you like 10 points. And then number C. Baraka Limited has a cost of capital of 10%. Now that's R. The cost of capital is 10%. And the company has 250,000 shares. Now that's N. N is the current number of shares. As the company has 250,000 shares, which are quoted at the security exchange at 120 shillings per share. So that is PO. So currently they are quoted at 120. The company earnings per share is 10. So what we need is expected dividends. So I told that. The company earnings per share is 10 and intend to maintain a dividend payout ratio of 50% at the end of the current financial year. So 50% of the earnings per share, because the dividend payout ratio is 50%. So they expect to pay a dividend of 5. The expected net income for the current year is 3. That is X. X is expected profit. We expect a profit of 3 million. And the available investment proposal are estimated to cost 6. I is 6 million. Required. Using Modiglian and Dimira model, show that the payment of dividend does not affect the value of the firm. Show that the payment of dividend does not affect the value of the firm. What does that mean? That means when the company pays dividend, or if it doesn't pay the dividend, the value will remain to be the same. First of all, determine the current value of the firm. So to get the current value of the firm, we have 250,000 shares, each at 120. So how much is the value of the equity or the value of the firm? Yes? 30 million. So you want to prove that the payment of dividend, if the company pays dividend or doesn't pay the dividend, the value will remain to be that. So now it's that no dividend payment. If we don't pay the dividend, how much will be the value of the firm? So now this is how we evaluate that PO is equals to P1 plus D1, 1 plus R. PO is the current market price per share, which is 120, is equals to P1. Now P1 is the expected market price per share. That's what we need. Plus D1, how much is our D1? So D1 is 0. So in this case, you're saying that there is no payment of dividends. Then 1 plus R. So our R we have is 10, 0.1. So you cross multiply. So this is 120 times 1.1 is equals to P1. So that means P1 to get an amount of 132. So that is the expected market price per share. If that would be expected market price per share, now we determine the amount trace. MP1 is so that you take the investment amount, you minus the expected profit, but you need to raise more to satisfy the payment of dividend, ND1. Investment amount, we need to invest 6 million, but of this 6 million, at least we expect to make profits. So you minus the profit. The expected profit is 3 million plus. Now, this is the total dividends. To get the total dividend, you take the current number of shares, which is 250,000. That's our N, times D1. How much is our D1? So D1 is 0. Remember, you are not paying any dividends in this case. So therefore, the amount raised you need is 3 million. If that's what you need to raise, since we have already used the retained earnings or the expected profit, so that means you have to issue new shares. So how many shares will you issue? So we determine MP1, I mean M, the new shares to be issued. We take MP1 over P1. We need a capital of 3 million and the expected market price per share, that's P1. The market price is expected to be 132. So how many new shares will we issue? $22? Sorry? 727. Good. So if that's the number of new shares to be issued, now we can be able to determine the value of the company, NPU. So to get NPU, you take the current number of shares plus the new shares to be issued so that you get the total number of shares. Then you multiply by the expected market price per share. And then you minus the amount you expect to invest, but it will give you some return. So you add the expected profit, 1 plus R. N is the current number of shares. We have 250,000 shares. M is the new number of shares to be issued, 22,727. So that once you get the total number of shares, you multiply by the market price per share. And the expected market price per share is 132. Then you minus the amount you need to invest, which is 6 million. Then you add the expected profit. You expect a profit of 3 million. 1 plus R, 0.1. So give me NPO. So now we assume now we pay the dividend. So now with payment of dividends, you do the same evaluation. That's PO is equals to P1 plus D1, 1 plus R. PO is the current market price per share, which is 120. P1, that's what we need, the expected market price per share. Then you add D1. So in the payment of dividends, so the expected dividend to be paid is 5. 1 plus R, 0.1. So it will be 120 times 1.1 is 1, but 2 is equals to P1 plus 5. So therefore, P1 will be an amount of. So now once we determine the expected market price, we also need to determine the new funds to be raised to undertake the project, and that is MP1. Say that to get MP1, you take the investment amount, you minus the profit, then you add the total dividend to be paid. The investment amount, we need 6 million, but at least we'll make a profit. So the profit will minimize the amount required, 3 million. Also, you need to raise more because you'll be paying dividends. So you take N is the current number of share, which is 250, and then D1. So the dividend per share is 5. Sorry? 4.25. Good. So that's the amount we need to raise. So if that's the amount we need to raise, how many new shares? Because we have to raise using the new shares. So it get M. M is MP1 over P1, which we have is 42.50. Then you divide by the expected market price per share, which is 127. That 3? 465. Good. So now with that, now we can be able to determine the value of the company. So to get NPO, you take the current number of shares, which is 250,000, plus M is the new shares to be issued. So in this case, we have is 33,465. You multiply by P1. So if you pay the dividend, the expected market price per share is 127. You minus the investment amount of 6 million. Then you add the expected profit of 3 million, 1 plus R. Yeah, so in that case, we have proven that we don't pay the dividend, and when you pay the dividend, the value of the company will remain the way it was before. That. Assignment. April 2023. You do it now. April 2023, question 3B. So now this for May 2014 is already in your notes. You don't have to copy again. Limited currently owns 100,000 shares. So that is N. N is 100,000 shares outstanding. Ordinary share with a market price of 10. So that is PO. PO is 10 shillings. And the firm has 1 million shillings earnings after tax. That is X. X is the expected profit, which is 1 million. and intend to invest 2 million during the year 2023. Expect to invest, that's the investment amount, which is 2 million. The firm also is considering declaring a dividend of 5 shillings per share at the end of the year. So that is day one. They expect to pay a dividend of 5 shillings per share. The firm opportunity cost of capital is 10%. R is 10% required. The price of the share at the end of year 2023, assuming dividend is not declared, so that one will just determine P1. Number two, the price of the share at the end of 2023, assuming dividend is declared, also that one is P1 if you pay the dividend. And then number three, the number of new shares to be issued. That is M. So that one is very simple. So, but I want to do it in full. So what they have asked is partially. So we want us to prove that the payment or non-payment of dividend does not affect the value of the firm. So first of all, determine the current value of the firm. The current value of the firm, we have 100,000 shares, each at 10. So that means the value of the company is 1 million. So now we need to prove that the payment of dividend or non-payment of dividend does not affect the value of the firm. So that with no dividend. With no dividend, PO is P1 plus D1, 1 plus R. PO is the current market price per share, which is 10 shillings, is equals to P1 is expected, D1 is 0. Of course, in this case, we are not paying any dividend. 1 plus R, the cost of capital is 10%. So P1, yeah, you just take 10 plus multiply. It's 1.1, you get 11. If this is the expected market price per share, we need to determine MP1. That's the new funds to be raised. Whereby you take the investment amount minus the expected profit, total dividend. We need to invest 2 million minus the expected profit of 1 million plus ND1. N is the current number of share, which is 100. And then D1 is expected, which is in this case will be 0. So in this case, MP1, we need to raise is 1 million. So if you need 1 million, how many shares will you have to issue? So we determine M, the number of new shares to be issued, by taking MP1 over P1. We need 1 million, and the expected market price of at the end is 11 shillings. That means we'll have to issue how many new shares? Sorry? 909. So we get the value of the company NPO. We take the current number of shares plus the number of new shares to be issued, P1, minus the invested plus the profit, 1 plus R. And the current number of shares, we have it's 100,000 shares. M is the number of new shares to be issued, 9,909. P1 it's 11, minus the investment of 2 million, plus the expected profit of 1 million. 1 plus R, 0.1. What are you getting? Now, with the dividend payment, do the same. PO, it's P1 plus D1, 1 plus R. Yeah, I'm repeating again the formula so that you can understand. So PO is 10. What we need is P1 plus D1, which is 5. 1 plus R. R is 10. So this one will be equivalent to 11 is equals to P1 plus 5. And P1 is 86. And then from there, I determine the new funds to be raised. It is the investment minus the profit and D1. So we need to invest 2 million. X is the expected profit. It's 1 million. And then you add the total dividend to be paid. So take the current number of shares is 100,000 multiplied by the expected dividend of 5. Then from there, we need to determine M. M is the number of new shares to be issued. So by taking MP1 divided by P1, so MP1 is 1.5 divided by P1 of 6. How many shares will we have to issue? 250,000. Then from there, we can get the value of the share, mean the value of the company. You take the current number of shares, which is 100,000, plus the number of new shares to be issued, which is 250. Then you multiply by P1, which is 6. You minus the expected investment of 2 million, plus the expected profit of 1 million. 1 plus R. You can copy that one. It's not in your notes.